By the end of this video, you will know exactly how to turn your 401k into a wealth-building machine that could hand you over $1 million by retirement, and you'll have a step-by-step plan you can start today, even if you've never invested a single dollar in your life. Here's a number that should make you uncomfortable. The average American retires with just $88,000 saved. That's not a typo. $88,000 to last potentially 30 years. Meanwhile, people who truly understand how to max out their 401k are retiring with seven figures, sometimes multiple seven figures, using the exact same salary you earn right now. The difference isn't luck. It isn't a trust fund. It's knowledge, and in the next 15 minutes, you're going to have all of it. But before I reveal the one strategy that most financial advisors never tell their clients, a little-known approach that can literally shave 5 to 7 years off your retirement timeline, let's start with the fundamentals that 90% of workers get completely wrong. Here's what you're going to walk away with today. First, you'll understand exactly what a 401k actually is and why it's the single most powerful wealth tool available to everyday workers. Second, you'll learn the precise formula for calculating how much you should contribute, down to the exact dollar amount. Third, I'll show you the specific investment selections inside your 401k that separate millionaires from everyone else. And fourth, that hidden strategy I mentioned, the one that changed everything for me personally when I finally discovered it. Quick, if you've ever felt confused or overwhelmed by retirement accounts, if you've ever wondered whether you're doing this whole 401k thing right, hit the like button right now. It tells the algorithm this content is valuable and helps us reach more people who desperately need this information. Let's talk about the real problem here, because I see it every single day. You're working hard. You're earning a decent paycheck. Maybe you enrolled in your company's 401k years ago, picked some random options that sounded reasonable, and you've basically ignored it ever since. Sound familiar? You're not alone. Studies show that 73% of workers spend less than an hour total, their entire careers total, thinking about their 401k investments. Here's what that costs you. Let's say you're 30 years old earning $60,000 a year. If you're only contributing 3% because that's what your company auto-enrolled you at, you're putting in just $1,800 annually. Over 35 years with average market returns, that grows to roughly $300,000. Sounds okay, right? But if you maxed out your 401k at the current $23,000 limit, that same 35 years turns into $2.8 million. The difference between those two numbers? That's $2.5 million left on the table. That's beach houses, that's generational wealth. That's the difference between counting pennies at 70 and living your absolute best life. But here's what nobody tells you. The people who build real wealth through their 401k aren't financial geniuses. They simply learned the rules of a game that everyone else is playing blindfolded. Today, you take off the blindfold. So what exactly is a 401k? Strip away all the jargon, and it's simply a retirement savings account that your employer sponsors. The name comes from Section 401, subsection K of the Internal Revenue Code, which is incredibly boring, but here's what's not boring. The government essentially bribes you to use it through massive tax advantages. Think of your 401k as a special vault with 3 superpowers. Superpower number 1 is tax-deferred growth. Every dollar you invest grows completely tax-free until retirement. No capital gains taxes eating into your returns every year. No dividend taxes, nothing. Your money compounds without the government taking a bite. Superpower number 2 is the upfront tax deduction. When you contribute to a traditional 401k, that money comes out of your paycheck before taxes. Earn $60,000 but contribute $10,000. The IRS only sees $50,000 of income. That could easily save you $2,200 in taxes this year alone. Superpower number 3, and this is the big one, is the employer match. This is literally free money. If your employer matches 50 cents on every dollar you contribute up to 6% of your salary and you don't take full advantage, you're rejecting a raise. You're saying no to free cash. Yet 42% of workers leave employer match money on the table every single year. Here's where most people get this wrong. They think of 401k contributions as an expense, as money leaving their pocket. Wrong. It's money moving from your pocket into a different, better pocket that grows exponentially. The real expense is not contributing. Stop. Before I continue, this next part is critical because it determines everything else. You need to understand the difference between traditional and Roth 401k options, and which one is right for your specific situation. A traditional 401k gives you the tax break now. You contribute pre-tax dollars. Your taxable income drops today, but you'll pay income tax on every dollar you withdraw in retirement. A Roth 401k flips this completely. You contribute after-tax dollars, meaning no tax break today, but here's the magic. Every single dollar you withdraw in retirement, including all your growth, comes out completely tax-free. Let me show you how this plays out with real numbers. Say you're 30, you contribute $10,000 annually, and you retire at 65. With average returns, you'd have roughly $1.1 million. In a traditional 401k, if you're in the 22% tax bracket in retirement, that's actually only worth about $858,000 after taxes. But in a Roth 401k, that full $1.1 million is yours. No tax bill waiting. The mistake 80% of people make is choosing based on what feels good now rather than thinking strategically. If you're early in your career with lower income, Roth often wins because you're paying taxes at your lowest rates ever. If you're in your peak earning years in a high tax bracket, traditional might be smarter. And here's a pro move. Many people split their contributions between both, hedging against future tax rate uncertainty. This next section changed everything for me when I finally understood it, so pay close attention. We're talking about contribution limits and the math of maxing out. For 2024, you can contribute up to $23,000 to your 401k. If you're 50 or older, you get an extra $7,500 catch-up contribution, bringing your total to $30,500. These limits don't include your employer match, by the way. That's on top. Now, $23,000 might sound impossible if you're making $50,000 a year. I get it, but let's break down what maxing out actually means for your daily life. 23,000 divided by 12 months equals $1,917 per month. Sounds like a lot, but remember, traditional 401k contributions reduce your taxable income. If you're in the 22% bracket, that $1,917 contribution only reduces your take-home pay by about $1,495, still significant, but not as scary as the raw number. Here's the real way to think about it. You're not losing $1,917 a month. You're paying your future self first, and that future self will thank you with compound growth that turns every dollar into potentially $8 over a full career. Most people skip this step, but don't. Calculate your actual target contribution. Take the annual limit, subtract what your employer contributes, and divide by your number of pay periods. That's your per paycheck target. Write it down. Tape it to your bathroom mirror. This number is your new financial North Star. If you've made it this far, you're already ahead of 95% of people, and what I'm about to share in this next section is the most valuable part of this entire video. Don't skip it. Subscribe to Ozar Wealth Decode Plus if you haven't already. We drop a brand new money strategy every single day at 6 p.m. Hit that notification bell so you never miss one. Let's talk about what's actually inside your 401k, because contributing money is only half the battle. Where that money goes determines whether you retire comfortably or retire wealthy. When you open your 401k portal, you'll see a menu of investment options. Most plans offer somewhere between 15 and 30 choices, and this is where eyes glaze over and people make devastating mistakes. I need to pause here because this is where most people go wrong. They see complicated names like Large Cap Growth Fund or International Equity Index and either panic pick something random, choose whatever has the highest recent returns, or default to the most conservative option because it feels safe. All three approaches can cost you hundreds of thousands of dollars. Here's your actual strategy. First, look for index funds, specifically ones tracking the S&P 500 or total stock market. These have the lowest fees, called expense ratios, and historically outperform most actively managed funds. If your plan offers a fund with index in the name and an expense ratio below 0.1%, that's usually your best bet. Second, understand target date funds. These are labeled something like Target 2050 Fund based on when you plan to retire. They automatically adjust from aggressive to conservative as you age. They're a solid set-it-and-forget-it option, but check the expense ratio. Some are needlessly expensive. Third, never put your 401k in a money market or stable value fund unless you're within 5 years of retirement. Yes, these feel safe. Yes, they won't lose money in a crash, but they also won't grow. A 25-year-old with their entire 401k in stable value is essentially guaranteeing they'll never build real wealth. The specific allocation that works for most people. Take 110, subtract your age, and that's the percentage to keep in stock funds. The rest goes in bond funds. 30 years old, 80% stocks, 20% bonds. 50 years old, 60% stocks, 40% bonds. Simple, effective, backed by decades of research. But here's what nobody tells you about 401k fees. A seemingly small difference in expense ratios creates massive gaps over time. Let's say you have two funds with identical performance. Fund A charges 0.05% annually. Fund B charges 1.0%. Over 40 years with a $500,000 portfolio, that difference costs you over $200,000 in lost growth. $200,000 for picking the wrong fund on the same menu. Log into your 401k today. Find the expense ratio for every fund you're invested in. If anything is above 0.5%, look for a comparable index fund option. This 10-minute task could be worth more than a year's salary over your career. Now let's talk about the employer match formula because leaving this money behind is financially insane. Common match structures look like this: 50% match on the first 6% of salary, or dollar-for-dollar match on the first 3%, with 50 cents on the dollar for the next 2%. The math varies, but the principle is constant. You must contribute at least enough to capture every dollar of employer match before you do anything else with your money. This isn't my opinion. This is mathematical fact. An employer match is an instant 100% return on your money if it's dollar for dollar, or 50% if it's 50 cents on the dollar. No investment in history consistently delivers those returns. Not real estate, not crypto, not that stock your cousin swears is about to moon. Nothing beats free money. Here's your action item. Find your company's match formula today. It's in your benefits portal or your employee handbook. Calculate the exact contribution percentage needed to capture the full match. Set your contribution to at least that amount immediately. Then, and only then, consider maxing out beyond the match. The biggest wealth killer in your 401k isn't bad investments or market crashes. It's something far more common: cashing out when you change jobs. 42% of workers cash out their 401k when leaving an employer. This triggers income tax on the entire balance, plus a 10% early withdrawal penalty if you're under 59.5. A $50,000 balance becomes roughly $32,500 after taxes and penalties. You lose $17,000 and decades of compound growth in one terrible decision. When you change jobs, you have 3 smart options. Option 1, leave the money in your old employer's plan if the fees are reasonable. Option 2, roll it directly into your new employer's plan. Option 3, roll it into a traditional IRA for potentially more investment options. The key word is directly. The money goes from one retirement account to another without ever touching your hands. One form, usually called a direct rollover or trustee-to-trustee transfer, and you're done. Never, under any circumstances, take the check personally and try to redeposit it later. The IRS treats this as a distribution with brutal consequences. Let's make this actionable. Here's exactly what you need to do starting today. Today, in the next 10 minutes, log into your 401k portal. Write down your current contribution percentage, your current balance, and the expense ratios of your investments. This is your baseline. You can't improve what you don't measure. This week, do 3 things. First, calculate the minimum contribution to capture your full employer match and raise your contribution to at least that level. Second, review your investment selections and move any money sitting in high-fee funds or overly conservative options. Third, if your plan offers Roth 401k, decide whether you should split contributions or stick with traditional based on your tax situation. This month, set up automatic contribution increases. Most 401k platforms have a feature to automatically bump your contribution by 1% every year. Enable this. You won't notice the difference in your paycheck, but in 10 years you'll be contributing significantly more without any additional effort. For tools, Empower, formerly Personal Capital, is free and lets you analyze your 401k fees alongside all your other accounts. Bloom is another option that specifically audits 401k investments for a small fee. Both can reveal hidden costs you never knew were draining your account. Now, remember that strategy I mentioned at the beginning? The one most financial advisors never tell their clients? Here it is, and it's called the Mega Backdoor Roth. Not every plan allows this, but if yours does, it's a game changer. The standard $23,000 401k limit is for employee deferrals, but the total contribution limit, including employer contributions, is actually $69,000 in 2024. Some plans allow you to make after-tax contributions beyond your normal limit and then convert those to Roth, either within the plan or via rollover to a Roth IRA. This means you could potentially shelter $69,000 per year instead of $23,000. That's triple the tax-advantaged space. Over 20 years with average returns, that difference grows to an extra $1.5 million in retirement savings. Check if your plan allows after-tax contributions and in-plan Roth conversions. Call your HR department or plan administrator and ask specifically about Mega Backdoor Roth capability. Let's bring this home with your 3 key takeaways. 1. Your 401k is the most powerful wealth-building tool available to you. Treat it as your financial foundation, not an afterthought. Always capture the full employer match. It's literally free money with guaranteed returns. 2. Max out your contributions, or at least set up automatic annual increases to get there. The difference between 3% and maxing out is the difference between scraping by and retiring wealthy. 3. Keep fees low and stay invested in diversified index funds. The boring approach beats the flashy approach almost every single time. Comment below. Which of these strategies are you going to implement first? Is it increasing your contribution, switching your investments, or checking if your plan allows Mega Backdoor Roth? I read every single comment, and I'll personally reply to as many as I can. In tomorrow's video, I'm revealing the exact step-by-step process to roll over old 401k accounts without paying taxes or penalties, something that took me years to figure out and most people never learn, costing them thousands in lost retirement savings. Subscribe right now so you don't miss it.